Hello and welcome to Enrich Academy. In today's video, we're going to give you a simple explanation on derivatives, futures and options. This video will give you a brief idea on financial derivatives. Basically, derivative is a financial instrument which derives its value from an underlying asset. In simple terms, a derivative is a contract whose value is based on something. So what are financial instruments? Financial instrument can be any document that represents an asset to one party and liability to another. In simple terms, financial instruments mean shares, bonds, currencies, etc. Similarly, derivatives are financial instruments. Now, what is an underlying asset? An underlying asset can be stocks, bonds, commodities, currencies, market indices, and interest rates. We can also see a lot of derivatives in our daily life. For example, let's take curd and cheese. These two products are derived from milk. So curd and cheese are derivatives from milk, and milk is the underlying asset. Both curd and cheese have a value of their own, but both their values will depend on the price of milk. So we can clearly understand here that the value of a derivative changes or is affected by its underlying asset. So when the price of milk increases, the price of curd, cheese, and other dairy products also increases. Likewise, we can see petrol and diesel are derived from crude oil. So you can see that crude oil is the underlying asset here, and petrol and diesel are its derivatives. So the price of crude oil affects petrol and diesel price. Now, if the underlying asset is a commodity like cotton, wheat, silver, gold, crude oil, we call it a commodity derivative. And when the underlying asset is a debt instrument, share, index, or currency, we call it financial derivative. So the point to understand here is that a change in the value of the underlying asset will bring about a change in the value of a derivative. For example, let's take a stock derivative of ITC. If the value of ITC stocks increases, the derivative of the ITC's value will also increase automatically. So the future of ITC's value will increase only when the stock of ITC increases, which means when the underlying value of the asset increases. So what are the different types of derivatives? There are 4 types of derivatives: forwards, futures, options, and swaps. So before we look into the 4 types, we need to understand the importance of derivatives. Derivatives are primarily used for 2 major aspects: hedging and speculation. Hedging in simple terms is used to minimize the risk in the physical market. Speculation is used to speculate or to gauge the direction or trend of the market. For example, if I research and think that the market may move up or down, I'm speculating here. So if I think the market may move up, I would think of taking a profit. And if I think there is going to be a fall in the market, I may think of a short sale, which means I will sell first and buy later. So let me make it simple for you with an example. When the market price of a stock is at 5,500, let's say you sell the stock at this price because you speculated or thought that the market price may drop or go down. So you sold your derivatives, which could be future or option of any stock, say ITC derivative or Nifty's derivative. So you sold the stock for 5,500. Now imagine if the market price falls down to 4,500. Here you have actually gained a profit of 1,000, right? So what you could do here is buy the stocks when the prices go down to 4,500. This is where derivatives come handy, as you can sell your position first when the stock prices are high and later buy when the stock prices go down. So the second reason why we take a derivative is because we may want to hedge our position. So what's hedging? Hedging, as said before, is a risk management tool. So the difference between speculation and hedging: speculation is done to earn a profit, whereas hedging is done to reduce your losses or risks. Say for example, you have bought shares worth 50 lakhs. Now if the market keeps moving downwards or if the price of shares keep reducing, then the value of 50 lakh shares may drop drastically and say it comes down to 10 lakhs. So in order to reduce this kind of a loss, you use hedging. It's like an insurance policy. You enter into a derivative contract in order to hedge your position. So now that you've understood the concept of derivatives, let's look at the first derivative, futures. So what are futures? So basically, futures contract is an obligation, which means you cannot back out once you enter the contract. It's an obligation to both the parties, meaning the buyers and the sellers, for transaction of an asset like a commodity, stocks, currency, and so on. It also has a predetermined future date. Now, these derivative scripts have an expiry date and price, and that is what we say predetermined future date. For example, if you type in a script in your trading platform, you will be able to see months next to the script. Say, for example, you type in Nifty. You see here Nifty June futures, Nifty July, Nifty August, right? So futures contracts have a maximum of 3-month trading cycle. Near month, next month, and the far month. So in this case, Nifty June is the first month and is called the near month. Nifty July is the second month and is referred to as the next month. And Nifty August is the third month and is called the far month. So after every month, the next month or the subsequent months will be called the near month, next month, and far month in order of the months. Now, the expiry of futures is always on the last Thursday of the month. So for the current month, June, the expiry was on the 25th of June, which is the last Thursday of this month. And if Thursday is a national holiday, the futures expires the previous day, which is Wednesday. Now remember, shares or stocks don't have an expiry period, but futures and options do have an expiry period. Let's have a look at the market depth to understand the expiry price. Have a look at the market depth here. You can see here ITC and Nifty July's future. You can see the bid price over here. What you need to understand is that derivatives are always bought in lots. You can buy one share, but when it comes to derivatives, you have to buy it in lots. You can buy 1 lot, 2 lots, 3 lots, and so on. So what is a lot? Lot is the minimum quantity of shares that you have to purchase. So here you can see the minimum quantity mentioned here. And if you decide to buy at this bid price, you have to buy this quantity. So the difference between buying the normal shares of a company and the futures is that you have to buy 1 lot in futures which contains the minimum quantity. Say, for example, if you had bid for 300 this month and the following month the price went up to 400, then you get a profit of 100, which means 100 multiplied by the lot size. Let's say lot size is 1000. So 100 into 1000, you get a profit of 1 lakh. Now let's try and understand forwards and future contract. Both are quite similar in nature. Let me explain with an example. Let's take a wheat farmer who wants to sell his wheat at 50 rupees per kg, which is the current price. But he can harvest his wheat only next month. Now what's the guarantee that he can sell the wheat at 50 rupees next month? Now in this case, the farmer tries to find a buyer who agrees to buy the wheat at 50 rupees next month. Here, both the buyer and the farmer enter into a contract stating that they are ready to buy and sell at the fixed price of rupees 50 next month, even if there is a price fluctuation. So if the price of wheat rises to 55 rupees, or if it goes down to 45 rupees, 50 rupees will be the price of wheat for both the farmer and the buyer, as they have entered into a forward contract. But here the contract is between the farmer and the buyer only, so it is not controlled or regulated. The price, date, and size are all decided by these two parties. So it's basically a customized contract. So forward contract is basically an over-the-counter or OTC derivative, which are directly traded by two parties without any intermediary person. Now, if the farmer wants to buy the wheat in a stock exchange or a derivative exchange, it is called future contract. In a future contract, there is a mediator, which is the stock exchange or the derivative exchange. Here your risk is managed as the exchange takes care of your risk, and the future contracts are transparent and regulated by SEBI. The price, date, and size are all decided by the exchange. So now that you've understood futures and forwards, let's try and understand options contract with the same example. Now imagine the price of wheat increases to say rupees 70. The farmer will be at a loss of rupees 20 per kg, right? As he had already entered into a forward contract with a trader before, which obligated him to sell the wheat at rupees 50, even if the price had a fluctuation, correct? So in order to reduce his loss, the farmer decides to insure his contract. It's quite similar to an insurance that you take for your vehicle or like a health insurance. So what happens when you take an insurance? You have to pay a premium, right? And the insurance company takes care of the expenses incurred by you, right? Likewise, the farmer also has to pay a premium when he enters into an options contract. So say for example, he pays a premium of Rs 5. Now when the price of wheat goes up, the insurance company will pay him the extra money of Rs 20. Now even if the price goes to say Rs 100, the farmer will get the extra 50 for his wheat. But if the price of wheat goes down to say Rs 45, then the farmer will not get any extra amount from the insurance company. So here, his loss will be the premium that he has paid, which is Rs 5. So basically, what the farmer does here is to transfer his possible risk to the insurance company with the help of options contract. This is how options contract works in a derivative market. So I hope that you're now clear about derivatives, futures, forwards, and options. If you found this video useful, please do like, share, and subscribe. Thank you.